Hey, John and Linda, thanks for coming in today, meeting with me. Enjoyed meeting you folks a few weeks back. Look forward to getting to know you both better and helping you with your financial goals and your financial planning. I prepared a detailed report for you, which you'll get a copy of, and we'll go through. Just kind of want to highlight the key items that I'm going to talk about that are addressed in the plan. First was your retirement goals. You had a 15,000 a month a retirement income goal, which is about 108, which is 180,000 a year. You wanted that to last for 30 years. That's going to take a little over $4 million today to fund, and you don't have quite that in investable assets yet. You have around, as you'll see in the report, about a little over 2.4 million. So we're going to have to continue to dialogue about this, about how to do that. I think we could probably do better than 5%. I think if we were to, I think we could do 6, 7%. But I wanted to go over that with you in greater detail because we wouldn't not be able to do that just yet. I know you're going to sell 2 of your homes. That will help, and I know you're planning on selling, Linda, your business. That will help. So that's something that we're going to have to continue to talk through and develop a thorough plan with. Um, and then secondly, with retirement, a key point was your pension, John. I know you have 2 options. Um, you have an annuity option and a lump sum. In looking at them both, you're in the calculations you'll see in the report I'm giving you. Your pension is only going to pay you around 2.2% over your lifetime of 20 years. I think we could do a lot better than 2.2%. So my recommendation is to take the 1.2, roll it into a IRA rollover. I think we could get north of 5%, maybe even 6, and then we'll pay taxes on that as money comes out. Um, with your single life, your single premium deferred annuity, John, I would highly recommend you annuitize it. I know there's an option you want to know about withdrawing. I would not do that. The whole how it's taxed is a lot different. It's on a LIFO basis. So everything your 79,000 that you put in is going to get taxed, is going to be received last. Um, and so the you're gonna, and it's gonna get taxed at ordinary income rates. If you do the annuitization of it over the 20 years, you'll be able to exclude about 24%, as you'll see in my calculations in the report. Make a huge difference in how the money's taxed. Insurance, really only 2 major points there. Everything is fine. I would like you to think about changing your beneficiary, John, from your boys to Linda, obviously to help her with that retirement goal of 15,000. And then we might want to look into, John, getting some insurance on her if she were to pass before you. I think that will also kind of assist in that meeting that retirement goal. Something that hopefully won't cost a whole lot of money. That's something that I can help with. Um, Homeowners insurance was another one that you're going to have to address. Your co-insurance, you're a little shy there on meeting that requirement on your both homes, but especially on your primary residence, as you'll see in your kitchen fire claim. You're not going to get the full amount because you didn't meet the 80%. I have all the projections there in our report. Umbrella and auto, you're fine. Estate planning, you have both of you had old wills, 20 years old. My immediate recommendation is to hire an estate attorney to help draft and update your wills, help you with, and basically you would both name each other as your executor for your will. Basically, an executor handles all the transactions if either of you were to pass, all the affairs, and make sure that everything is fine. There's a lot of, and also to do a trust. I think you guys are a candidate to do a trust. I am not an attorney. I'll let the attorney handle that, but there's a lot of benefit from doing a trust. I outline a bunch of things in the report. I have I use an example of a revocable living trust. There's this trust that you can fund at death. Um, but basically making sure that if it's not named in the trust, any property, that you title it in your name jointly, either with that would include property that you buy in the future, bank accounts, any kind of investment account, that it's you name each other as the beneficiary for that pool of money. So you avoid probate. Monies are transferred efficiently, but mainly you want to avoid probate, as I stress in the report. So really a trust. And another benefit would be to uh, have a durable power of attorney. That's if you get in a situation where you're incapacitated, you need somebody to, there's a medical durable power of attorney um, that the attorney could draft, that basically you want to have. It's all part of planning, but we'll go more into that in detail. Real estate, tax consequences. I'm not a CPA, so therefore I can't technically give you tax advice. But given your retirement income goal, um, selling the properties makes sense. You're going to take a loss on the vacation home. It's a depreciated property. You're going to have a slight gain, and as I show you in the report, on your primary residence, given if you get the full market value sale. But then again, I would be able to, and that your CPA would be able to help you as to how to offset that those amounts to minimize or to maximize your tax. Lastly, your sale on LC publications. It's an installment sale. You know, you want to. I do all the calculations. Basically, you're looking at about a $75,000 gain on the $100,000 down payment, and about another $25,465 gain, and about $47,118 of interest paid for 2017 alone. Again, a CPA. I go through a lot of detail in the report. We're going to go through that, but that's kind of just the nutshell of that. And then, Linda, your investment portfolio. In a nutshell, we need to diversify this portfolio. It's highly concentrated. You have about 51% of the whole entire portfolio in 4 stocks. That some of them have very high betas that are highly correlated to the market. So it's a highly volatile portfolio. We need to balance it out with an asset allocation that's more balanced. I make some recommendations in the report of either a balanced 50-50 or 60-40, but to have so much in 4 stocks is taking a lot of risk. And then we need to, so I would really want to get your cash flow statement to really understand what you guys are spending. I think I list a whole list of documents that I would need to really complete and do a more thorough job. Your cash flow statement is one of them. And then lastly is a situation basically that I just wanted to bring to your attention, John. Lewis has approached me wanting to know your asset allocation and monies, how you have invested. That's something that I would not be able to disclose to him. That's something that you would be able to, but not me. So those are the things that are in the report that I wanted to go over. So if you don't have any questions, why don't we start?